Hey, I'm Joe Rohde with West End Advisory Group. Welcome to our first webinar of the year. Today, we're going to talk about the economic outlook for 2025. Today's webinar is being recorded and will be available for viewing on our website. The West End Advisory Group, we have a plan-first approach to investing because we believe knowing how much money you need and when you need it is going to be the most important factors in your investment success. Joining us today is our guest speaker, Bill Puggini from Vanguard. Bill is a senior portfolio specialist at Vanguard Financial Advisor Services, where he consults with advisors on investment thought leadership and Vanguard's full range of investment strategies. If you have questions during today's presentation, please use the raise hand button and your webinar controls, and we will unmute you. Of note, Bill and Vanguard are not affiliated or endorsed by LPL Financial and West End Advisory Group. Now I'll turn it over to our host, our speaker, Bill. Bill, take it away.
Thank you. I appreciate the introduction, and thank you for inviting me on to speak. So, yeah, as you mentioned, we're going to talk a little bit about our economic and market outlook over the next year. Now, I will say, the way that we do things is we look at the economy over the upcoming year, the way things are going, things like monetary policy, economic growth, and inflation. We forecast in the near term over the next 12 months or so. Right, those are very data-dependent variables. As we look at things like market returns and how we forecast the market, we actually look out over about 10-year time horizons as opposed to one-year time horizons. With markets, the case is that typically over a very short period of time, the market is driven more by what participants think is going to happen than what actually happens. And what we find is that over the course of 10 years, returns more accurately reflect, fundamental data over that longer period of time than they do in the short period of time. So in the way that I'll be talking about things will sort of be in that framework, right? Economic stuff really over the course of a year, market returns and forecasts for our investment portfolios would be over the course of 10-year horizons. So let me start by sharing our outlook on the economic side. So again, these are going to be things that we're looking at over the course of the next 12 months. So and you have the U.S. here at the top of the chart. And not only do we include our numbers, but we also include either the trend numbers or also forecasts for the same numbers. So for 2025, we're expecting GDP growth north of 2.1%. Unemployment rate, we think, is going to be about where it is now at around 4.4%. Inflation, using a core measure of inflation, we expect that to be about 2.5%. That's currently about 2.8%. And monetary policy, in other words, the federal funds rate, we expect to be at 4% by the end of 2025, which would mean that the Fed cuts rates 2 times. So, really to dig in, what do these numbers ultimately mean? I think the important part here is that what we're forecasting is that GDP growth, remains pretty robust at above 2%. So that's relatively strong and trend-like for the U.S. economy over the last 10 years or so. Unemployment rate, right? Again, we're not forecasting a recession or a significant slowdown. So we expect, the employment rate to remain somewhat steady. Meanwhile, inflation coming down a little bit, right? So that's essentially the goal of the Fed over the last few years. Since inflation got out of control, we're all aware of higher prices, and we're all feeling those effects still to this day. What I would say with inflation is, that getting inflation under control doesn't mean that prices are likely to go back down, just simply that they're not likely to continue growing at as fast of a pace. And so really it's essentially what the Fed wanted, right? You have the economy remaining robust, remaining strong, but yet you continue to have inflation coming down, which is a little bit of what I would describe as like Goldilocks, or the ideal scenario for the Fed, right? Usually, what a lot of economists were forecasting is that the effects of such higher interest rates, essentially the Fed went from 0 to more than 5% in less than a year. Usually the effect of that is that it causes a recession, and that's in essence how you get the price reductions or the inflation reduction. But we've been really fortunate that the economy has remained robust, and that inflation has also come down at the same time. Now, that said, it is a somewhat sensitive balance, and there are still potential risks on the inflation side, which is why we think that rates are still likely to remain somewhat elevated throughout 2025, and why we're only forecasting 2 cuts, which is in line with what the Fed is now forecasting. It's in line with their last communication with the market. We actually saw some drawdowns in the equity markets as a reflection of what is described as more hawkish policy, meaning less supportive, fewer cuts being forecasted from the Fed. That actually caused the market to come down a little bit because usually lower rates are more supportive for markets. But we think it's about right for the Fed to cut likely about 2 more times. At the risk of getting somewhat too technical, I'll try to keep this relatively basic. I don't love the chart, but just want to talk a little bit about the concept. And that's really that we think that we have gotten somewhat lucky as an economy here in the U.S. over the last couple of years. As I mentioned with the Fed, when the Fed raises rates, ultimately what they're trying to do is lower demand, basically decreasing spending by making borrowing costs higher, right? So making mortgage rates, we're all probably aware of how much mortgage rates have increased over the last couple of years from all-time lows. That also impacts borrowing costs for companies who are financing their growth. And usually the result of that means less spending and less growth on the GDP side. So from the economic front, that's what typically leads to price reduction also. What has actually happened has been, on the opposite side, the thing that the Fed really doesn't have any material effect on, and that's the labor market and also the productivity. So on the labor market, where has the Fed gotten lucky? Well, more people have entered the workforce. So just having more people willing to work typically means you don't have to increase the prices of the current, increase the wages of current workers by as much. So that allows people to fill jobs at lower rates, but still continue to fuel the economy. And then the other one, which is incredibly unpredictable, is the productivity of each worker. So how much can each worker actually get done? What you see on the left-hand side of this chart is that for the U.S., both the supply, how many workers are in the workforce has increased over the last couple of years, and also how much they're able to get done for each worker has also increased, both of which is more significant than we've seen in any other country across the economy, or any of the major countries that you can see on the chart here. So in some ways, the Fed got lucky. It's been more of this labor dynamic in our view, why the economy has remained strong, as opposed to the interest rate side and the things that the Fed has an effect on. But ultimately that's a good thing, and it has continued and will likely to be continuing to fuel our economy over the next year or two. But I mention it because those are the things that we're really going to be keeping an eye on over the next couple of years. Is what does the number of workers look like, and how productive are those workers will be very telling on what happens with the economy here in the U.S. The other thing that there's certainly been all eyes on, it's been really the major theme of the last couple of years, is artificial intelligence. So what you can see here is that the U.S. is actually responsible for about 70% of artificial intelligence investment. And so that really has been fueling, in our view, a lot of speculation, right? I mentioned the market tends to react to what they think is going to happen. Certainly, we've seen a lot of the rollout of artificial intelligence products. We're seeing a lot of that make its way into certain tech companies, ways of doing things. But we haven't really significantly seen artificial intelligence really permeate the economy and make significant improvements. We do think that that's coming. And certainly, it is substantial in the U.S. You can see, about 70% of that investment coming from the U.S., outpacing really the rest of the world. What this chart's showing is really the adoption and the impact of artificial intelligence. So the lines, it's really 3 lines. It's our really optimistic scenario, our baseline scenario, and our downside scenario of really ultimately how much, what percentage of, repetitive jobs get replaced by artificial intelligence. Sorry, I don't want to say the jobs are getting replaced, but the portions of the jobs, right? So our view with artificial intelligence is not the dystopian one where it's going to, throw a lot of people out of work. Just that it's going to make people more productive, which is really important, again, for the economy, and that it's going to replace something like 20 to 30% of our daily jobs, certainly making them easier and allowing us all to focus on higher priority, higher value activities. But what you can really see from the chart is that we don't see any meaningful uptick in that productivity gain from artificial intelligence in our baseline scenario, and for at least a few years. In the upside scenario, we start to see that maybe in the next 2 to 3 years, but more likely closer to 2030. in our view. So, in some essence, I think it's a good news story that we're really optimistic about the impacts of artificial intelligence on the economy, but also, cautious of how much the market has appreciated over the last couple of years on the coattails of artificial intelligence, being that we're yet to see really a significant benefit from that yet. So something that I think are it's a little bit of a push-pull here in the U.S. right now, because we're dealing with really high valuations, but at the same time, some optimism that can in some ways justify some of that optimism. Lastly, I'm just going to talk a little bit about valuations, and then I'll get into our market forecasts. The teal line on this slide, that's a measure of valuations here in the U.S. So basically, the price that you're paying to buy U.S. stocks. What's important here really is both the level of that teal line, but also relative to the gold line. The gold line, in essence, is what we think stocks are worth. So really, what you can see is that the teal line is significantly above the gold line, to the degree that's probably we haven't seen something as significant as that divergence since the dot-com bubble. That doesn't mean we think we're in anything like the dot-com bubble. It's just the most comparable period. There's a lot of reasons why this period is, if things look a lot better, you have a lot more companies that actually have real earnings. It's not as extreme as we saw back then, but it does give us pause that valuations are so high in this current market. So, and what I think, everything kind of starts with the equity market for an investor, right? That's the core of most of our investment portfolios. It's where you see the most appreciation, and certainly we've seen that over the last 15 years or so. So you start with, what are the expectations for the equity markets? Over the last 15 years, it's been an incredible run for the stock market. So much so that, a lot of people that I talk to are sort of questioning why they hold anything else in their investment portfolio. So it's important to remember, some of these other times and why you hold things other than equities. And I think now is a really good time to do that because, with such strength that we've seen over the last 15 years, as I mentioned, things are now a little bit out of balance to where it's making our expectations of the future a little bit more murky in stock markets and making other aspects of an investment portfolio more important in our view. So, to provide a little bit of context, we'll focus on the left-hand side of the page here, which really is focusing on our outlook for U.S. equities, equities outside of the U.S., and then U.S. bonds and bonds outside of the U.S. Now, again, we look out over 10-year time horizons for these numbers, and we create a range of probabilities, right? So we're guessing that or forecasting that returns will fall somewhere within that range, and the dark bar is our current estimates. So as you can see, for U.S. equities, our return forecast is 2.8 to 4.8%. That's really quite jarring if you think about it. The returns for U.S. equities over the last 10 years has been over 12%. So our outlook is significantly reduced, given the challenges of the starting price, right? Like when you're an investor, the price that you pay really matters. Just like when you buy anything that you expect to go up, if you pay a really high price for it, it's harder for it to go up a lot than if you buy it for really cheap. And so that's where we're at with U.S. equity markets. Now, I think the good news is that everything else looks more attractive than it has over recent periods of time. So international stocks, we think returns closer to 7 to 9%, largely because of a couple of things. But one, the starting price is a lot lower in international markets. So even though there isn't as much AI optimism in international markets, you're just paying a much lower price. And a lot of the benefits that are created by AI are likely to flow through and broaden out the impact across the market, including in international. On the bond side, we expect 4.3 to 5.3%, both for U.S. bonds as well as international bonds that are hedged to U.S. dollars, meaning you don't have currency effects. And again, I think that's a really big one because, in some ways it could be actually higher than our forecast for equities. I mean, certainly it's at the higher end of the equity valuation range, and then edges slightly above that. The importance there is that our forecasts are pretty close on the bond side to what they are on the equity side, but that also comes with significantly lower risk. So typically risk is measured by standard deviation for investments, meaning like you might have an average of 2.8 to 4.8%, but the standard deviation is about 15%. So that means in any given year, you can be 15% lower or higher than that average return, or even more in some cases. For bonds, it's only about 5%. So you can see that 5%, even on the downside, still has you close to a positive return for bonds, whereas on the equity markets, if you take that average and you subtract 15%, you're well into negative territory. So really what I'm saying is, hey, it still makes a lot of sense to have a balanced portfolio. You don't not want to hold equities, right? The last 2 years has shown us why. We've been fairly pessimistic in our view on U.S. equities for a few years, but returns have continued to be strong in the short term. Again, we're sort of at this, there's a little bit of a tug of war going on between optimism and a little bit of speculation towards the future and high equity valuation. So right now that optimism has been winning out in the form of higher returns. So that's rewarded equity holders, but at the same time, it has increased the balance of risks, meaning it's just as important to continue to hold things like fixed income or bonds, as well as international stocks. So really what we're saying is continuing to hold a broadly balanced portfolio will ultimately prepare you for just about any scenario that could possibly happen going forward. Inflation is the one thing that really can hurt both equity and fixed income returns, but outside of that, usually things that are good for equity markets are bad for bonds, and usually things that are bad for bonds are good for bonds are bad for equity markets. So they tend to sort of offset one another, which is why you include them together in an investment portfolio. And it really makes your investment portfolio a little bit more all-weather and able to withstand different types of environments. So we continue to be an advocate for broad diversification across the investment portfolio. And so what I would say is, don't let the recency of strong equity market returns make you think that you need to get everything into equity markets, because again, it's sort of shifting the balance of risks within a portfolio. So we again just advocate for the importance of holding a very broadly diversified portfolio that can prepare you for all these various different things that can happen. Because ultimately, I think the message here is that the next 10 years is likely to look very much different than the last 10 years. And we think these other asset classes will play a much more important role over the next 10 years than they have over the last 10 years. So with that, I'll go ahead and open it up to any questions that you all have.
I'll start us off. Could you take a look at the fourth slide, or the number was 4 on it. It was the productivity slide.
Yeah, I can put that up.
And I just want to make sure I was I know that, the Eurozone hasn't kept up with, domestic productivity and everything, but am I interpreting that right? Does that mean that there was actual negative productivity in several of these countries like Australia and Canada?
Yeah, it's the change in productivity. So it is something that can sort of move up and down year over year. It's not something that is always getting higher, as you might expect. But yes, that's exactly what it's showing, is that on a per worker basis, they were producing less than the year prior. And so that kind of gets to, in some ways that can be lucky sometimes, right? We don't think that AI was driving a lot of this productivity. It might be something that's easy to point to, but it's not something that's really infiltrated everyone's day-to-day jobs to make them more productive. Yet over the last year and over the last few years, we have seen the average worker in the U.S. become significantly more productive. And you can see, yeah, as you mentioned, right, not only on the positive side, but it's the highest growth that we've seen in productivity that relative to all these other large countries. And a lot of them have actually seen workers become less productive, which is a big part of why we've seen so much more strength here in the U.S., while a lot of those economies have suffered what was more in line with expectations from a couple of years ago, when everybody was sort of introducing rates. Again, the expectation is usually a slowdown that also then brings down inflation.
Productivity with workers declining is near the end of an expansion when you start getting the least productive workers come online. But
right.
Anyway,
yeah. Exactly.
I guess the next question I have with regard to just the sheer amount of debt that the United States is, we've crossed the 30 trillion mark. At what point does that start impacting our ability to control interest rates and the huge supply? When does demand just start not keeping up with that?
Yeah, it's quite frankly a tough question to answer. I mean, right now our debt to GDP ratio is right around 1 to 1, meaning we need to pay as much in debt as we're producing, and certainly we've seen deficits in spending more than what we're bringing in. So that ratio is likely to increase going forward. So yeah, I mean, for us, it's an important issue. It certainly is a longer term issue, and I think that in a lot of ways is the challenge here, right? Like usually, I don't want to get political, right, and all that sort of thing, but a lot of times what gets addressed by the government are like things that are causing issues and current challenges. We aren't yet seeing the impacts of those deficits in terms of making our debt more expensive in the U.S., causing folks around the world to question whether those debts will get paid off, right? If you buy treasury bonds, we're not yet seeing those effects, so they are further out in the future. We do think it is very significant, but it can take a long time for those to actually. They sort of don't matter until they matter, right? And what I mean by that is like you might not see any impacts via the debt markets and the creditworthiness of the U.S. Until all of a sudden everybody just does care about it because it gets too far out of line. So I think the good news is that we're not at that latter part just yet. We do think if we continue on the trajectory that we're on, that we could, with the current trajectory, we could start getting to levels of concern by certainly the end of the decade and into the 2030s. Artificial intelligence, in some ways, has the ability to help us grow out of that. Right? There's two ways to offset. Those deficits. One is you can either spend less, or two, you can earn more. It's hard to earn so much to outgrow the issues of the deficit without having some sort of spending cuts on one side. So it's a little bit of a non-answer, but I guess ultimately what I'm saying is that we don't expect any issues in the markets over the next couple of years as a result of the spending, but it is something that's very important to be addressed by the economy, and something that we are optimistic that artificial intelligence and the productivity gains from that is something that could help lighten that load in the future, but it's going to require, likely to require government action to get it ultimately under control, over the coming decade.
It looks like we have a question from Steve Williams. I'm going to go ahead and let you unmute yourself, Steve.
Okay, yeah, thanks. Question on the supply chain slide. I noticed that China was not included in there.
Right. China is not included in there. Yeah, I don't know exactly what it looks like for China. We do have a China-specific slide. There's been a lot more stimulus in China, which has been more significant over the recent year or so. Right, for most of the developed world, we're sort of in a different phase of the economic, like more towards the end of the economic cycle. China is sort of through to the other side, where they've had a lot of the effects of the recession, and now are very stimulative. So we're expecting their economy to grow at about 4.5% over the next year, with a lot of support from the government and things like monetary policy as well as fiscal policy, things like housing support, et cetera. And then, certainly the impact of tariffs is something that will, in the U.S., could weigh heavily on China's economy and subtract as much as 0.25%.
Bill, Steve does a lot of work
Sure.
in China. Are you in China now, Steve?
I am, yes.
Do you have something specific on China that you might be able to share with us that we could get this to Steve?
Well, no, everything that
Yeah,
said was spot on. I mean, there is a lot of stimulus here, but there is still a very integral supply chain here for U.S. products.
Mhm. Yes. Yeah, I mean, right. That also gets like, you kind of get into the tariff discussion here in the U.S. as well as what's likely to happen. And I mean, the reality with tariffs is there's still a lot of uncertainty, right? I mean, you have what's talked about, then you have what's what they say they want to do, sort of what they actually want to do behind the scenes, and then what they can actually get done via negotiation. So there is a lot of uncertainty there. Certainly,
Right.
tariffs could have the potential to weigh heavily. Supply chains don't move quickly, to your point, especially from some of the larger companies around the globe, which make up the majority of the market. So, there's a lot of uncertainty as to like what the ultimate impact of tariffs could cause in the short term. It certainly causes some concern for, inflation here in the US, but that would be short-lived, right? Because you might see sort of a one-time price hike as supply chains move, if supply chains move, but you're unlikely to see that continuing to grow, right? Which ultimately is what inflation is. And then you tend to see some winners and some losers from sort of a reshuffling standpoint of those tariffs. But we sort of stopped short from going too far because of all the uncertainty with what actually will get enacted. And then once things get enacted, right, there's always sort of like, loophole might be a strong word, but sort of like ways around, technical ways around some of the tariffs. Companies have proven to adapt pretty quickly to issues and causes as they did last time there were tariff increases. So there's still a lot of uncertainty as to like what the ultimate effects would be there.
Right. There is a difference between promises and policy.
Right.
And what are your insights on the energy sector? I know that was heavily discussed during the debates and election.
Yeah, on the energy sector, I mean, we think it still continues to be important, right? I mean, there's certainly this like secular longer term shift towards renewables, but in the short term, there's also this tremendous energy demand from especially AI. Like, I mean, it's kind of all eyes on AI. I mean, it also requires a ton of energy. You're seeing a lot of talk about nuclear and how ultimately the energy, where it's going to come from to be able to power a lot of the artificial intelligence from the energy side. So I think we're optimistic. We hear from a lot of our active equity sub-advisors are both optimistic about the future and transformation of the energy sector, but also recognizing sort of the near-term needs of traditional energy as well as the long-term benefits of a shift to renewables.
Okay, and then do you have any comments on the impact of BRICS?
BRICS, yeah, I mean, ultimately, I think a lot of it comes down to like what's likely to happen with tariffs. Certainly, I mean, if you see China as being one of the biggest areas that's most challenged by tariffs, then that makes it, those supply chains have to go elsewhere. So that could benefit other parts of emerging markets. You could start to see a little bit more of a broadening out. I mean, right now, China makes up more than half of emerging market economies from a market cap perspective. So you could start to see some broadening out of that. Certainly we see a lot of those countries as being global suppliers, if you will, both from the energy front as well as precious metals and things like that go into electrification. So still think it plays an important part of an investment portfolio going forward. But there's also some risk there as well from the supply side, and again, so much uncertainty with how tariffs ultimately flow through to the global economies.
Okay, all right, thank you.
Thank you, Steve. Are there any other questions for Bill before we let him go? Seeing no other questions, we'll call it a night. Thank you all for joining us. Bill, thank you for your time this evening. Really appreciate our partnership with Vanguard, and appreciate your time this evening. With that, we'll close today's seminar. Thanks everyone for coming.